In this video, I would like to discuss the key lesson I learned from François Rochon from Giverny Capital. If you don't know who François Rochon is, this is one of the best Canadian stock investor we have, and he has a fund called Giverny Capital. They have been in business for 30 years and they have been investing in great companies at a reasonable price. And if you look at the performance of Giverny Capital for the past 30 years, you can see that they have made 15% per year for 30 years. And they have beaten the S&P 500 and other indices, investing the Warren Buffett way. So you invest in companies, you don't gamble on stocks. And the key highlights I got from reading all their letters is this table that I can show you. Here we go. Perfect. This is a table. I don't know if you can see well. Let me zoom in a little bit. That may be better. What can we see in this table? Okay, you can see Rochon global portfolio and the S&P 500. Okay, you see different columns. Let's start from what is at the left. You have value and you have the market. What they include as value, what they say value is the intrinsic value of these businesses. So the way they calculate the value column here is the growth in earnings per share, and the dividend yield. So if the earnings per share, the EPS is growing 20% and they have a dividend yield of 1%, this stock has a 20 plus 1%. They have a 21% increase in intrinsic value. And they do this for all their stocks in their portfolio. They aggregate it depending on the allocation of their portfolio. So you can have an aggregated number of the intrinsic value of your portfolio that is growing 14% in 1996, 17%, etc., etc. And they compare this growth in intrinsic value with the market, the stock prices. So this is not the same thing. The value is not equal to the market. You see here for this year, 1996, the intrinsic value of their businesses has grown 14%. But in the stock market, the stocks have grown 29%. So you have a difference of 15%. What you can say from this table, you can say different things. First, the value, the intrinsic value will fluctuate. You can't have a constant plus 15%. Some years will be great, some years will be bad. And what you can also see from this chart is there is always a difference between value and market, and the market can extrapolate this data by a lot. The market growth can be double the size of the value growth. You can grow intrinsic value by 15%, but in the stock market you grow 30%. And also you have a reverse effect. Look at this. 2008, the intrinsic value has decreased by 3% for their businesses, but in the stock market they declined by 22%. Same thing for 2009. You have no growth for the earnings and the dividend yield, but you have an increase of plus 28% in the stock prices. This is short term, right? Year after year, nobody knows if stocks will go up or go down. You have external shocks, you have liquidity, macro. In the short term, anything can happen. But what you can see at the bottom of this table is this, annualized. You see that since 1996, the value, the intrinsic value they calculate, has grown by 13%, and the stock market gains were 13% for almost 30 years. You see that the starting point is 1996, and you have an annualized performance of 13%. And I told you at the beginning of the video that they did 15% per year, because here on the first table, the starting date is not the same. Okay, so you get the difference between 15% and 13%. Okay, very well. And the same phenomenon is happening for the S&P 500, right? The intrinsic value, the way they calculate it, the market difference, and now you have roughly the same thing. You have a 1% difference, but you get my point. Over decades of investing, at the end of the day, the stock prices will follow earnings per share plus dividend yield. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. At the end of the day, in the very long term, stock prices will follow the intrinsic value. For the S&P 500, the value has grown by 9% roughly, and the stock prices increased by 10%, have increased by 10%. So roughly the same thing. You see that there is zero difference for Rochon and difference of 1% for the S&P 500. And I have recently read all their letters since inception, available completely for free on their website. And the conclusion is this: sometimes investing doesn't have to be very complex, sophisticated. You just buy companies when you think they can grow earnings per share, including the dividend yield, of roughly 15%. And if you do that long enough, your portfolio will grow by 15%. This is the most important thing I learned from their letters. They talk about macro, the markets, the ups and downs of this difficult market, but at the end of the day, they talk about companies, right? And I recommend you guys that you read these letters. They are great. You can type Giverny Capital on the internet. You will find decades of letters, and for every letter, they always mention this table or different tables depending on the portfolio they have, and this value market difference table, which is great. If you have a portfolio filled with companies that can grow 10-15% per year, they can grow their intrinsic value by 15% per year. In the short term, it will widely fluctuate, but in the long term, like 1 decade, 2 decades, 3 decades, it will average out to the EPS growth plus the dividend yield. This is the main takeaway I have from this letter, and I thought it was really interesting. They don't focus on macro, they don't focus on the short term, they focus on can you grow 15% for a sustainable period of time. And that is the second takeaway. How can you grow 15% per year for a sustainable period of time? You need a moat. You don't need, you need to have a business that will not erode over time. They completely avoid cyclical stocks. They focus on retail, consumer, maybe tech, digital media companies that will compound because they have a moat. So sometimes investing is that simple, not easy, simple. You focus on great businesses with a moat, and you think they can grow 15% per year because they've done it in the past. A good example that these letters highlight is Orly Automotive, and this is a company that I can show you the stock price. This is a company that has been outperforming all indices for decades now, and they always surprised to the upside. They have guidance and they have greater numbers than expectations, basically. So you are just getting better and better and better. And after many years, you don't doubt management. You don't doubt their process. You don't doubt the capital allocation policies and the moat. Orly is just an amazing compounder that has benefited from every era of investing for the past 20 years, 30 years. This is just excellent. And François Rochon has a certain talent to find the Orlys of this world. And this portfolio is filled with Orlys like this. And if you want to check their portfolio, actually you can go to Dataroma. You can go to Dataroma, Giverny. You will find it on Dataroma completely for free. François Rochon, here it is. You have the portfolio. So in case you want to find good candidates that can grow 15% in the future, here you go, guys. Here you go. You have a few candidates here. And if you read their letters, you will find the narrative why they bought certain stocks. So pretty interesting. And that's a good reminder for what to focus on. In the short term, anything can happen. But in the long term, earnings per share matter. At the end of the day, this is what matters in the long term. And the last point I want to address, and after this, that will be it for today, is the valuation, the PE ratio. If you have a business that can grow 15% per year, what is a good PE ratio to buy this stock? That's a good question. Now you may say that the PE ratios of the Western world, the PE ratios are high. Well, they have been investing in the dot-com bubble, in the subprime crisis bubble, and in the past decade. And the PE ratios they mention are really similar to what we have today. PE ratios around 20, 25. They sometimes buy businesses with a PE ratio of 30. That's on the higher range. So I would say yes, between 10 and 30, that's a good range to find some good opportunities. And the takeaway of this letter is if you find a great business with a PE ratio between 10 and 30, and you don't shoot for the stars and you aim for a rational 13, 15% per year, this can be the goal, the dream scenario that can happen. And if you can sustain this kind of performance for decades, you will be immensely rich. So congrats to Francois Rochon and his team. That's some fabulous work. I highly recommend these letters. And that's it for the takeaways, guys. I wish you a nice rest of your day.
If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio. Additionally, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you are blocked, if you have any questions, I'm here to help. Click the first link in the description to get more information. You will get a video that explains how everything works completely for free. No need to sign up, no need for your email address. Just click the first link in the description and I'll see you on the other side.